a big thing for me is I think people forget that in the 90s, when the economy was running really well, that we did just fine with 3 to 4% inflation and similar interest rates. I think people have kind of gotten lulled into I don't want to say complacency, but they just kind of have this recency bias where the recent thing prior to COVID and the shutdown was 0% rates, which really spurred some kind of irresponsible growth in a way. And there was a reckoning, I think, really in 2022 when the Fed raised rates, and we saw that across fixed income and equity markets. And now there's an adjustment. We're like, well, the rates are still at 5+%, but the economy's growing fine. Earnings forecasts are coming in better. Corporate profits are okay. Margins are holding up. The employment market hasn't cracked. Inflation's coming down, and I think 2%, frankly, is pretty optimistic. But it's things are moderating, and I think we're seeing that the market can move and operate just fine in that environment. It's the change that's really painful for the market at times, especially in kind of a negative way where you're kind of resetting off of easier comps. But once you kind of get things in line and the market kind of knows what it's dealing with, which right now is higher rates and kind of moderate inflation, companies can adjust and they're able to operate in that environment. And I think for better or for worse, the ones that kind of, shouldn't maybe have existed or shouldn't have seen the growth that they did with 0% rates, there's a bit of a reckoning. But as long as that's, not the whole economy, which it isn't, I think we're plugging ahead. And, I'm as a result, I'm a little more bullish than bearish on things here.
Yeah. What with interest rates? So the Fed target as of right now is 5.25 to 5.5% on the Fed rate. And inflation's come down to, let's call it 3%. So people are, one of the things I've started hearing about is the real effective rate being now, 2 to 2.5% roughly, right? And so people are saying the Fed's going to have to lower rates just kind of because of that, right? Like the real interest rate or the real yield is too high over the inflationary number. But one of the things that I've been trying to kind of wrap my head around a little bit is the employment numbers are so strong. The GDP numbers are coming in good. And so, if the Fed lowers the rate to something, closer to the current rate of inflation, is that going to stoke the economy so much that then it reheats it in inflation? What's your thought?
I mean, I personally I think they should keep it higher for longer. I think that big reset in 2022 is behind us. 2023, I think, clearly showed that companies can adjust and operate. The housing market is a bit of a concern given the higher mortgage rates, but again, that's off of a recency bias of 3% rates. 5, 6. I think it'd be nice if it came in a little bit, but you saw that anchoring already change. Where rates went to 8 and everybody stepped away, and then as soon as rates got like a 7 handle and a 6 handle on them, people started stepping back in because they were anchored up at 8. So a lot of that is kind of behavioral bias that occurs. And, aside from that, I think the Fed could stand to keep rates higher. I think those inflation numbers aren't going to keep coming down in the manner that they did, just the way the math works, as I said earlier. And so I could very easily, lobby for the Fed just to kind of keep it where it is. And it also gives them more room to cut when stuff starts to deteriorate, because at some point it will. That's just the way the economic cycle works. Things will slow down. Germany's in a recession. China's in a recession. Other areas in the world are having trouble, and the U.S. at some point will start to again. The question is, when is that? And I don't foresee it really being, at least not the first half of this year. And so, at least for me, I feel like the government could keep things, or the Fed could keep things where they are, and the economy will kind of continue to chug along. And if, you start to see some cracks in that employment data, maybe they cut a little bit. But again, I think that a lot of this is still normalization coming off of, the COVID shock. And I think that's there, what was that term that was thrown on, the long and variable lags on different areas of the economy. And I think the big thing on that is like you didn't know how long and how variable that lag is. And some of these things have clearly taken way longer to play out than people thought.
Yeah.
And I think, it's that sort of thing where there's no real reason for the Fed to start cutting right now. So I don't know why they would, especially if the employment numbers continue to move ahead, kind of chugging along. And that inflation number, I think, will start to kind of flatten out. It might grind a little bit lower, but I don't see a ton of movement, below 2.5%, just given the way the math works and the way kind of that things are going right now.
Yeah, I'm trying to think who the first place I heard it was, but the idea that high interest rates, because there's so much cash out in the economy, high interest rates are actually a positive tailwind, right? Because
bringing cash in.
Yeah, you can just have, like no one has anything on the sideline, so to speak, right? You just go put it in something that's yielding, 4 or 5% relatively, obviously there's always risk in anything, but
you can get a CD for 5%.
Exactly. I mean, that's pretty much as close to risk free as you could be. And, you can get 5%. They'll pay oftentimes they'll pay they'll pay the interest monthly to you even. And, now you have, cash to just go spend in the economy if you're that person that has, all that cash, which to the younger generation, they might think like that is so unreasonable. But I think people that are a little bit older, like that's not uncommon to actually have a sizable amount of cash on the sides or now in cash equivalent or cash-like instruments that are just yielding, good income for them. And, providing some financial flexibility to go and continue to participate in the economy as a consumer. As far as the longer for higher, have you ever heard of Joseph Wang? Have you ever followed him at all?
No, I've not.
He's got so he wrote a book, Central Banking 101. He's an interesting guy. He used to work the trading desk at the Fed, and he presented at a conference I was at back in fall of 2022, and he started his presentation and said, people that are saying it's higher for longer are wrong. It's higher forever. Yeah. And then he had a really good presentation with some really compelling evidence about why, he felt things had fundamentally changed in the economy, the relationship with China and the labor that they were providing as a disinflationary effect, and everything really has changed. And so we're in a new secular regime or cycle that interest rates would just have to stay higher.